I'm your host, 𝗀𝗃 𝗘𝗶 and today I'm delighted to have the privilege to connect with somebody I've never met in person and is hiding behind a cartoon on LinkedIn. Let me welcome you, Tony, and I will try to pronounce your last name, McLaughlin.
Very good.
Thank you for joining us today. We're extremely excited to connect with you here on without our avatars, our real bodies, right? Where are you
Yes.
joining us from today?
I'm in London at the moment.
Okay. So I guess here in Zurich we have a sunny day, and I hope you have the same.
Very
And
nice.
yeah, and you know, I think you're a veteran in payments and in financial services. Most people know you for your long career at Citi. You've been involved in what I call blockchain for finance for a very long time. You were instrumental in the so-called RLN network, right? And you've been focused on digital assets, ledgers for a while now, and you recently launched your own startup, 𝗀𝗏𝗃. We'll have an opportunity to talk about that, but the main theme today is stable coins, and I don't want to say that it's a hype, but it's definitely a hot area. And I want to start from a basic question of how do you think of stable coins? Because different people think of them in different ways. Is it just another payment instrument? We have Nick Carter talking a while that we should think of them as the euro-dollar account. And how do you think of stable coins?
Okay, so I like to. It's great to be here, Effie. Great to speak to you. You know, long admired your work and follow you very avidly on LinkedIn. So I like to start from first principles. So the deepest I can go is that, you know, money for me is a monopoly of the nation state, and the nation state has the right to issue money. So then the next question is, what is money? And we've got to a situation where money is essentially an IOU. You know, your balance in your bank is a liability of your bank because they owe you the money back. So money is an IOU, and it's denominated in national currency. And then the next question on top of that, so it's at the very bottom, it's the right of the government to issue this thing called money. Then what is money? It's an IOU. And then the next question is, what is the form factor that we use?
Okay.
Now, in history, there have been many form factors for money. As you know, you can have a piece of precious metal in a coin, or you can have a banknote. And there are other form factors that have been developed. You know, there are checks, there's bills of lading denominated in national currency, there are credit cards and debit cards. There are bank accounts where you can see your balance and then you can move money through ACH and faster payments. But all of these different forms are really expressions of the same fundamental thing. These IOUs, these promises to pay. And the way that I see stablecoin is it's nothing more and nothing less than the latest way of expressing that very ancient idea of an IOU, which is issued either by the state or by the agent of the state, by the licensed agent of the state. Because this money, the national money, the fundamental thing about it is it has to emanate from the state. It's authorized by the state. And the state can do that either itself or it can license a third party to do it. And that third party could be a bank or it could be a non-bank. But the people who print money always need a license from the nation state. So what is a stable coin? It's just a new form factor for something ancient.
Okay. So you take it as a given that it has to be regulated. So
of course
it can fit. And I have to remark and notice that you didn't go down the classic economists sort of explanation of what is money, that it has to have those three standard
Yes.
aspects, if you want, of a unit of account, a medium of exchange, and a store of value, because I think there it would be a bit tricky to qualify stable coins or other aspects. And is that deliberate?
It's very deliberate. Well, it's deliberate for a couple of reasons. One is that, I don't know about you, Effie, but I get tired of hearing people say the same thing over and over again, because it's obviously not their own original idea. They just heard it from someone else.
Yeah.
And also, I think coming at things from a fresh angle, especially from a first principles angle, helps things become clear.
Mm-hmm.
And to your point about the stablecoin, so the stable coins that we see today, I am not claiming that they exactly fit into what they should fit into, what they should be. But what if the stable coin is seen as just being a new form factor of money, we need to make it fit into the standards that we expect of money issued by either a national government or by a regulated non-state actor like a bank or a regulated fintech. So it needs to have singleness of money. You know, a dollar is a dollar.
A dollar is a
It
dollar.
needs to be the case across all form factors.
Yes.
It needs to be the case. And so that's what we need to make true.
Okay.
For stable coins to be good.
And this is exactly where UBIX, if I understand correctly, is trying to put that piece in the puzzle that is missing, right? Of making that interoperability and uniqueness, right, of stable coins, or interchangeability.
Yeah. Well, I won't use this opportunity to promote my own thing. Let's stay at a slightly more general level to begin with.
Yeah.
If we say that what a stablecoin should be is just a new representation of sovereign currency, then what features do we want? And let's work backwards.
Okay.
Now, I see regulators making a mistake of looking at what we have now and trying to work forwards. And so I'll give you an example of that. If a regulator defines a stablecoin as a crypto asset with reference to fiat currency,
Mm-hmm.
I think they've made a fundamental mistake. That to me is equivalent of saying that a check is defined as being a piece of paper with reference to fiat currency. It's starting in the wrong place.
Yep.
In actual fact, what we've got here is a system of negotiable instruments. And a negotiable instrument denominated in dollars could be on a piece of paper, it could be on a traditional ledger, it can be on a check, it can be on a stable coin, it can be transacted through a card. But the core is the negotiable instrument, which is redeemable at par value on demand, denominated in national currency. And so I really think we should think about more normatively about stablecoins. What do we want them to be? We want them to be regular money, not Frankenstein money, not Quasimodo money, regular money. And I have a firm belief that if we set things up in that way, stablecoins as a form factor will be the dominant form factor.
Okay. My question was going to be, and I think you partially answered it.
Yeah.
What do you mean when you call yourself a stablecoin maximalist? I mean, it's a bit of an oxymoron, right? We have the Bitcoin maximalists, but here, the stablecoin maximalist, from what you've said up to now, I'm starting to understand why you want to call yourself that.
Yes.
Because you really want to sort of communicate the message or the narrative of, let's think of the principle of stable coins and not the specific, is this one, the form, the USDC, the USDT, or whichever, is it a good one?
Yes.
And that you are, loving these or giving your vote and your approval to these forms.
Well,
Yeah.
You are Greek, and Platonic forms should not be, anything strange for you to deal with.
Abstract thinking is
Exactly.
the core of philosophy, of mathematics, and of
Yes.
everything, of logic too, right?
Exactly.
And the language, the Greek language, is actually rich not only in terms of the number of words, but in terms of the abstract terms that allow us to think. And I love
Yes.
what you're saying of, going to the principles and really asking the questions, what do we want stable coins?
Yes. So let us deal with the abstract form, the Platonic form of the stablecoin, and reach that. And don't be confused by the thing you see today, because the thing you see today is far short of the Platonic ideal.
Yeah.
Right?
Yeah. But if you don't explain the ideal, we'll never be able to reach there. We will just be navigating, like wandering around, so to speak.
Precisely. So the reason why I call myself a stablecoin maximalist is, it's humor. It's humor.
Yeah.
Now, I'm actually kind of like secretly a Bitcoin maximalist, in as much as I admire the intellectual purity of Bitcoin. I admire the intellectual purity of Ethereum.
Yeah.
But the question is, when it comes to money, should money belong to the nation state, yes or no? And I believe that in most countries, the answer is yes, money should belong to the nation state because it's part of the social contract. Again, first principles. We as citizens, we give certain monopolies to the state to live for civilization. You can't have your own law. You can't have your own military. You can't have your own police force. You can't have your own money in most societies. Now, that's not true in every society, because in some countries, you can't trust the government with the law or the police force or the money.
Yes.
And so the existence of a Bitcoin is a lifeline for those people.
Yeah.
But in countries where we have good institutions and good legal systems, and we're trying to make our institutions are always imperfect.
Yeah.
And here's the question: do we abandon them, or do we try to make them better? And I think we try to make them better. So I do believe that the sovereign has the right over money.
Okay.
And I do believe that all money needs to be the same in terms of the singleness of money.
Yeah.
And I also believe that the form factor of stablecoins is superior to what we've seen before as a form factor because it's more general purpose. Mm-hmm. And again, abstract thinking and looking at the history of technology, general purpose technology takes over from special purpose technology when it's given a chance. So Effie, you and I, when we were younger, we were listening to vinyl records, and then we were listening to cassette tapes, and then we were listening to CDs. Yes. And now we're streaming on mobile phone.
Yeah.
So there's no special purpose music reproduction technology. It has been transplanted with general purpose technology. And when we were young, we paid in cash, and then we paid in checks, and then we paid in ACH, and then we paid in debit cards and credit cards and prepaid cards, and we pay in faster payments, and we pay in wallets. They're all special purpose technologies.
Yeah.
And you just have to ask yourself this question: is Ethereum, Solana, any one of the chains, is it more or less general purpose than a faster payment system? It's more general purpose. Is a token more or less general purpose than an MT103 message? It's more general purpose. So if we give this technology the chance and we bring it into the world as what it should be, just a new form factor of fiat currency, then the technology superiority, its general purpose nature, will mean that it will take over every payments use case, every payments use case. And again, I insist about, do not be confused about what we see today. Yes. In today's world, we see something that looks like cash. But soon we will see something that looks like cash plus checks. And then we will see something which is cash plus checks plus wire transfers plus cards plus everything plus more. So we should try to grasp this platonic form of the stablecoin, what it will be, and it will be an extraordinarily powerful form factor of fiat currency.
So I assume from all that you have said that you do not like to engage in debates of the nature CBDCs versus, private stable coins.
I do like to engage in those debates, but in my way of thinking, a CBDC is nothing more than a stablecoin issued by a central bank.
Exactly.
And a tokenized deposit is nothing more than a stablecoin issued by a bank.
Yeah.
And there should be no problem with a bank issuing a stablecoin against its balance sheet, and there should be no problem with a central bank issuing a stablecoin against its balance sheet.
Yeah.
And in fact, I would like to see, if a country insists upon doing CBDC, it should do the CBDC on the public networks.
Yep. Yeah.
Because that's where the people are. The money should go to the people. Don't ask the people to go to the money.
Yep. Yeah. And have a last mile problem.
You know, that if you think about the nation state, when it prints banknotes, it sends those banknotes into the world. Now, the world is a dangerous place. Now, so it's very strange when a central bank says we cannot possibly put CBDC on a public chain because the public chains are dangerous places. I'm sorry, but the central bank sends the physical banknote into the physical world, and that's a dangerous place as well.
Of course.
But the key point, the sovereign money needs to be on the places where people want to do business.
Yeah.
So the idea that there's a CBDC and everyone has to come to the money, this is wrong. The money has to go to the people.
Yeah. And they have to think how to architect those rails, right? So they can prevent the behaviors that they want to prevent.
Well, those rails, those blockchains already exist, and there are people and businesses on those blockchains. And if those people and businesses cannot access regulated money, they will use unregulated money.
Yeah.
So the greater harm is to deny people access to regulated money. If someone wants to transact in Ethereum or on any other public blockchain, then they should have access to sovereign money.
Yeah. So you have been thinking this well before, we have now JP Morgan issuing on a public blockchain their tokenized deposit, and we've had some very sporadic incidents on public blockchains by regulated institutions. Although I think in the private securities space, which is a different conversation altogether, but we've seen more there issued, private securities tokenized, or we've seen tokenized money market funds on public blockchains by huge entities like BlackRock and likes, right? So they're showing the way.
Well, the difficulty, if you are inside a bank and you want to outsource any part of your operations or technology, there are regulations around outsourcing, even if you want to do cloud, right? So if let's say that you're running a big bank and you have your own data center, and you say to yourself, look, I'm going to save a lot of money by getting rid of my data center and using a cloud provider. You have to go through a process called TPRM, third-party risk management. And essentially, you'll take a questionnaire of 100 pages containing 1,000 questions, and you'll send it to the cloud provider. And you have to establish that outsourcing is a responsible outsourcing. I mean, this is a regulatory responsibility on banks. Now, it's hard enough to go through that process when you're dealing with a cloud provider. When you're dealing with a public blockchain, who do you send the questionnaire to? So there's no third there's no third party.
Yeah.
So the fundamental one of the fundamental blockers.
Well, can I mean, I'm asking questions and maybe I can answer them myself, but they come to my mind. Except for Bitcoin, you know, you could say I'm going to send it to the Ethereum Foundation, for example. Most of the other blockchains have a foundation, but does
the
that?
foundation isn't the operating the system.
It isn't operating the system.
And so if the only lens, if you're in a bank and you want to use a public blockchain, and the only tool you have is third-party risk management, and you can't apply that tool to the public blockchain, you are stuck.
You're stuck. Yeah.
You are stuck. And what I think needs to happen, should happen, is the authorities have to decide in a they have a very limited number of options here. So do you decide that using a public blockchain is not an outsourcing? Or do you encourage the banks to develop a specific framework for blockchains that they can apply to blockchains? Or do you say that the public blockchains are actually like infrastructure? They're like the internet.
Like the internet.
And you don't need to do the evaluation on the base layer. You do the evaluation on your service provider. And I think that latter approach is the best approach. Don't expect. So here's I think a good analogy. Blockchain is just a place for doing business, like a street. So imagine if you live in Zurich.
A public space. It's a public space, right?
Exactly. But imagine, I mean, you live in Zurich and you probably don't have very many dangerous streets. But imagine the most dangerous street in the most dangerous city. Lots of bad things can happen on that street. So here's a question. Should a bank be allowed to operate a branch on that street? Well, I think the answer is yes. Now, is the bank responsible for everything that happens on the street? No. The bank is responsible for what happens in the perimeter. So we have to get a little bit more clear that the blockchains are venues for commerce, and denying access to those venues for banks and fintechs just means that people are underserved with regulated services. And that's the greater harm. So preventing banks from occupying this space is the greater harm.
Yeah, because we are forcing a parallel economy, if you want.
We create the vacuum, and the vacuum is filled by unregulated alternatives. Yeah. It's like saying to a bank, you cannot operate on this street because it's too dangerous. Well, I'm sorry, but the bank opening up on that street makes the street less dangerous.
But Tony, we've been doing this for years, and it's difficult to stop doing the same thing because we've had that, and we say, oh, we're not going to bank crypto companies, for example, said that for a while, or we're not going to bank, I don't know, gamers or people that deal with casinos, for example.
Yes.
We have all these rules because it's easier like that, but we don't think of the consequences. Well,
again, going deep, this stuff comes back to the law, right? So if these activities are permissible in the law, you know, these are the foundations of the state. The law defines what is permissible and what is not permissible, and the law defines that we have this thing called money, and that if you're engaged in permissible activities, you should be able to access regulated money. Yep. Now, if the law has got grey areas and we don't know whether it's permissible or not permissible, then let's deal with that at the underlying legal structure level. Let's not deal with it way up the stack, where a crypto exchange turns up at a bank and says, "Can I have an account?" And the bank says, "Well, I don't know." This is trying to resolve the problem at the wrong part of the stack.
Understood. Understood. Tony, if we were to recap the way you're thinking, because the narrative matters very much at this stage, where there's a lot of excitement in the market with stable coins.
Yes.
But it's more focused at a level of the product level.
Yes.
And the usual competition in the market, who can beat who, what type of target audiences are we targeting? Consumers? Are we targeting institutions with our stablecoin product offering? Are we partnering with incumbents, the card networks or fintechs and so on, instead of really looking at the big picture that you describe? Are you hopeful for the next sort of, let's say, 5 years as to where we are going? Are you more concerned about the wrong regulations coming in and really screwing, if you want, the possibilities there? And any thoughts?
Yes. I mean, it's foolish to make predictions, but I will make one because I'm not only hopeful, I see the developments as inevitable. I mean, I really believe that if we understand the history of previous form factors of money, and we look at the history of technology, and we look at the incentives on offer, my prediction is simply that we're moving into a world where every bank and fintech is accepting and paying with stablecoins for every use case. And that stablecoins will become the dominant form factor of money on the planet. That is my solid prediction. That is going to unfold before our eyes. And people should be both hyper realistic about it and also somewhat normative, because here's what I observe. I observe an over fascination of the stablecoins that we see today.
Okay.
And you can make mistakes. I always like to say that if we saw the first credit card, let's say we're back in the 1970s, Effie, and the first credit card has been invented, and we watch what is the first credit card and what do they do and what strategies do they have, and then we extrapolate from their activities and their business model into what we have today, we would make fundamental mistakes. So, but this is what we're doing. We're looking at the very early stages of the stablecoin evolution. We're trying to extrapolate forwards from the first issuers, and we're going to make big mistakes if we do so. Equally, I find it very regrettable that lots of policymakers who are making up the rules of the road on stablecoins have never seen a stablecoin, because in many central banks and many regulators, the officials are not allowed to have a crypto wallet.
Okay. Even the regulated, the USDC, for example, that's the most.
Many banks prevent their employees from holding a crypto wallet. So if the banks and the regulators and the central banks and the supranational bodies, if the people have never used the stablecoin, how can they have an informed opinion? I mean, I wouldn't take my dog to a vet who had only seen a PowerPoint presentation about dogs.
About dogs, yeah.
So if there's one thing that I'd like to pass on is, please find a way to get a crypto wallet, find a way to transact stablecoins between you and your team members, and actually experience the instrument that you're thinking about. That would be one thing which is very hands-on. And the second thing, which is more platonic and abstract thinking, so we move from the concrete to the abstract, is please do not look at a stablecoin and define it as a crypto asset with reference to fiat currency. Please recognize it as something much more ancient. It's a negotiable instrument which is denominated in sovereign currency which is issued by a regulated issuer. And negotiable instruments can be bought and sold, but they can also be redeemed at par value. And let's take a very normative approach, which is we want these things to be regular money. We do not want them to be Frankenstein money. And it's in our hands to make it so.
Interesting. And on that note, we'd like to close the conversation and thank you very much, Tony.
Thank you very much. It's been a pleasure to speak to you.